Welcome to the Corporate Treasury 101 podcast. In today's episode, we discuss the macroeconomic outlook and rising or settling interest rates with Amol from Chatham Financial. Amol is a seasoned professional with over 2 decades of expertise in derivatives capital markets. As the managing partner and chairman of Chatham's boards of directors, he spearheads the corporate sector, providing invaluable insights to some of the world's largest corporations. Chatham Financial is a pioneering firm specializing in the debt and derivative markets. Their unique approach combines expert advisory with cutting-edge technology to handle the highest volumes and broadest range of engagements in the field. In the episode of today, expect to learn: how do rising interest rates affect treasurers and markets, and how can risks be managed? What challenges do companies face with changing interest rates, and how do funding strategies differ? How has debt structuring evolved with shifting rates, and what new strategies are emerging? And like always, much more. Amol was absolutely great in explaining us in a one-on-one manner what is going on in the world right now and what we should expect in the coming year.
We truly hope you will enjoy the episode. And if that is the case, when you're thinking about how you found our podcast, chances are that it was through word of mouth, social media, or a recommendation from your favorite podcast platform. And this is our only request to you. The best way you can support the podcast is to head to YouTube and subscribe to our YouTube channel, Corporate Treasury 101. That will mean the world to us and help more people learn about treasury.
And with all that being said, please welcome Amol.
Amol, thank you so much for coming on to the Corporate Treasury 101 podcast. We'd love your insights on what's going on nowadays with the macroeconomy, interest rates, etc. I think all treasurers are quite interested. I think there might be a little bit of fatigue around hearing it again and again, but I'm sure you have some very interesting insights. So start us from perhaps the people that aren't keeping so close to the news. What is the current macroeconomic landscape, especially concerning the interest rates and how the interest rates are going nowadays?
Well, first, thanks for having me on the podcast, Hussam and Guillaume. Very excited to chat with you both and share some of these insights with the audience. I like to call us in the economy, certainly in the U.S., but really overall, in a little bit of a Goldilocks phase. Not too hot, not too cold, just right. That's probably the best way to think about it. Whether that holds true a few weeks from now or a few months from now, that's a different topic of conversation. But right now, it feels as though global central bankers have navigated this period of really high inflation, geopolitical challenges, wars going on, and other obstacles relatively well, better than I think most would have predicted. Economies continue to grow, but not too fast. Not too much growth to lead to more inflation. We're not seeing that much of a slowdown. And while unemployment, certainly, let me focus on the U.S. for a minute, is growing, it hasn't grown by so much that we have big global challenges like a global recession that's we're thinking about today as we record this. Again, who knows what could happen in the coming weeks and months.
So that's an interesting perspective, because I think most treasurers would disagree with you there about this Goldilocks zone, because I think for the role of the corporate treasurer is interest rates are high, my debt's expensive. That's really it. Perhaps the yield aspect of your savings have gone up, and that's nice and everything like that, but that's not the priority of a treasurer, right? For yield is not the priority. It's liquidity and then being able to raise debt and be not too much of a cost burden in how you support the business. How do you see the current interest rates and the environment impacting corporate treasurers?
Oh, I mean, that's a different question. The economy and how corporate treasurers feel is different. It's like anyone who's going to buy a house, they're looking at mortgage rates and saying, "Oh my goodness, this is so high." The flip side of that is, hey, thank goodness we don't have unemployment and you actually have income in order to be able to even potentially afford maybe a smaller house than you wanted. But for corporate treasurers, the big challenge is cost of financing has gone up by 2, 3, X, maybe 4X, depending on the type of company you are. High yield is a little bit of a different story than investment grade globally. And so this is not to make light of this, but there's a little bit of a grieving cycle here for corporate treasurers and CFOs, which is we all start with denial. Rates won't stay at 5% forever. And you can even see that in the forward curve. The market's expecting rates to come down precipitously, and that may happen. Who knows? But there's this bit of denial until eventually we all get to acceptance. We get there at different speeds. Different businesses have different abilities to withstand this rate shock. And I wouldn't even call it a shock. I mean, we have higher rates than what we've had the last decade plus. And so when we look at that scenario, companies are just going to be in different places on being able to get to acceptance. Some have gotten there, dealing with refinancing, dealing with acquisition finance, growing through this. Others have not quite gotten there yet, and they're really asking themselves the question of, will it get better in the future, or should I take what's available to me now? And very difficult, very difficult to answer that question in a vacuum. But I think that's my answer to your question, Hussam. It's that we're not everyone is at acceptance in the grieving cycle yet.
So does everyone need to know? So how do you see that playing out? What's your general advice on the macroeconomic trend to corporate treasurers? Is the best line of approach to do what you can with the current environment, don't expect it to come back down? Is it here to last?
Yeah, are rates here forever and here to stay? The market definitely does not believe that, right? When you look at the market is absolutely expecting recession in the future. To be clear, the market has been calling a recession for a very long time. That's not to belittle that call. It's just, I think this is going to be the most widely called recession in the history of the world. I mean, everyone and their grandmother will be able to say that, I saw this coming. So, your question is, what can companies do and what can corporate treasurers do today? I think, unfortunately, the best time to be prepared for higher rates was yesterday, but the next best time is today. And, from a capital structure standpoint, having a laddered capital structure is ideal rather than having everything maturing all at once. Having a variety of funding sources is helpful. So not just relying on one market. So if you're a bank borrower, just relying on the bank market might be challenging because banks can be interested or not in lending to your business or to your industry. Diversifying funding sources, diversifying your capital stack, all of that is really helpful. And even in the current environment, thinking deeply about, what your future capital structure looks like, how you should be thinking about sources of debt, fixed, floating, how you should be thinking about hedging. Now that, as a firm, Chatham spends an inordinate amount of time working with our clients on financial risk management, and interest rates is a big piece of that. So we have lots of depths that we can get into here. We don't want to go down too many rabbit trails, but I think those are some of the pieces of advice that I would have is, yesterday was the best time, but the next best time is today. It shouldn't matter whether rates are higher or lower. Really developing a capital structure and a robust hedging program that withstands all of these different scenarios is the job of the corporate treasurer, to really take that to the CFO and the board and make sure everyone's aligned to support that program.
I like that a lot. And it's funny to see that the circumstances change. The framework on how to handle risk management doesn't. Like diversification, making sure to mitigate the risk, having different sources of funding is evergreen concept that you should be applying anyways, whether it's high or low interest rate, because A, anything can change over time. So that's what happens. And B, when it changes, you want to be prepared. And that's what risk mitigation is all about here. To maybe make the parallel between, people who want a mortgage and afford a house, and maybe the interest rates cannot allow such a big house nowadays, but maybe tomorrow it will. What's the recommendation for people or for companies who are sub-investment grade or, on the contrary, investment grade? Are there different considerations here, given the macroeconomic outlook? Should they be watching out for the same things or a bit different? If the cost of debt is much higher, does it mean sub-investment grades are how to put that, incorporated in a bad position? Or what should they do? What are the differences here?
Yeah, Guillaume, I'd say there are different scenarios to consider for high yield versus investment grade. So starting with investment grade, capital sources are plentiful for them. Bond markets are open. And yes, the cost of financing is higher, but we've seen it, frankly, for the last 3 years that the ability to get financing for investment grade companies is not necessarily the challenge. The challenge is, can you get to acceptance on the higher rates? And are there, some different structures that you want to consider, even in the investment grade space? But investment grade, I think, has a bit of an easier time, to your point, than the high yield issuers. We've seen many times over the last several years where the high yield market is closed. Hung term loan Bs on bank balance sheets has closed things down number of times. Banks have taken large losses on buyout loans and other, loans of that type. They've marked down the value of those, which just makes it harder. The good news, though, is that there's a whole new source of capital that's come in that has been in the market for a long time, but has really come in force, which is on the private capital and private debt side. You see some of the largest alternative asset managers in the world raising these private capital and private debt funds. So it's those sources of capital are really taking what used to be, I would call it traditional bank lending, and putting it more on the balance sheet of these funds. So taking it off of the banks onto these funds. There's a tremendous amount of capital that's been raised for these vehicles, which means they're chasing deals, which means they're looking for good companies to lend to. And so while rates are higher, and there have been more often periods of challenging funding environments for high yield companies. The good news is more sources and a lot more capital going to those new sources of debt, which means that there is funding available for companies that want to. And if you're a high yield borrower, that's one of the conversations that certainly we've had advising on capital structure. Do you want to take your term loan B and turn it into and replace it with private debt capital instead? So go from bank borrowing to a different institution. So there are a lot of these types of opportunities that are available. Again, the hard thing is you have to come to acceptance that the cost of financing is higher. Not just are rates higher, but the spreads are higher. And one strategy is hope. But I think there's some famous line that says hope is not a strategy. That certainly is something to consider. Just wait and see if things get a little bit better. But will things get back to where we were immediately at the time that we were during COVID, where we saw 0% interest rates or negative interest rates in Europe and other places around the globe, phenomenally tight spreads, tons of investor demand for all these types of assets. It feels like a little bit of a different world today than what we were in just a few years ago.
And so to take the other side of the spectrum, for the company who look into investing in this high yield environment, how does it work? What are the circumstances for them that needs to be taken into account when it comes to investing because they have an excess of cash?
Yeah, we're not cash experts, but I will say, isn't it nice to get a return on cash for the first time?
For sure is.
You're not just talking about earnings credits against big balances with 0% or negative interest rates that you're earning on it. You're actually able to generate some return. And so, some of the conversations that we've heard from our clients, which tend to be large multinationals, corporate treasurers of those types of firms, has been a move away from some of the incremental search for yield that was happening in the low rate environment and back to basics is maybe the best way to put it on investment and cash management today, where we say, hey, we don't have to get too creative about the incremental search for yield because there is yield and return available for our balances. This is generally true for investment grade companies. Well, sorry, yield's available for everybody, but investment grade companies are the ones that have cash to invest as opposed to high yield borrowers. But it's a little bit, again, like I said, back to basics of, let's just make sure that we're looking at the right tenors, the right asset classes. We're not tying up our cash for too long. We have the right level of liquidity that we want. And there is, again, capital that you can invest with lots of places where you can generate forget positive, but a decent return. So this goes back to what we were talking about earlier. This idea that these strategies that companies come up with, whether on the financing side or the investing side, are essentially evergreen, and they should be somewhat agnostic to the market environment, with of course tweaks for the market environment. It's a little bit different being borrowing at 8-9% money versus borrowing at 3-4% money. But having a strategy that endures and survives through all of that is what I would say the leading treasury professionals, capital markets professionals have put in place.
Makes a lot of sense. Amol, we would love to deep dive into debt structuring and funding and how all this macroeconomic landscape and change in interest rate and maybe whether it's here to stay or not, how does that impact treasury and how they should be thinking their debt structuring. So maybe can you walk us through that to begin with? Like, can you dive into how the interest rate changes are affecting debt structuring for corporates and maybe at the same time and making the link with the banks? How does that impact corporates, but also banks in the debt structuring?
Yeah, absolutely. I think so. What's interesting is if you look at it from a macroeconomic standpoint, most of the studies would say this global rise in interest rates has not actually hit corporate interest expense all that much. It hasn't been that dramatic of a move. And the reason for that is that most companies have moved towards, certainly if you're investment grade, tend to be more heavily fixed rate borrowers with issuances that happened pre-pandemic or during the pandemic, really in a lower rate environment. And so, yes, rates are higher, but if your next bond doesn't mature for 7 years, you're watching it and saying, well, let's see what happens. There's probably a whole nother cycle to go before, we need to do something. For those that are more floating rate borrowers, again, very different. And they're impacted certainly on the cost of their term loans or any floating rate debts that they have outstanding. That cost has certainly grown significantly, particularly if the company has not hedged their interest expense. The most prudent floating rate borrowers have hedged in some way or had hedged in some way. Maybe they hadn't hedged 100% of their debt. Maybe they hadn't locked it up with interest rate swaps, and maybe they'd purchased some interest rate caps for essentially consider them a form of insurance. You have some risk that you're willing to take, and then above that, the cap will protect you. So there's been some marginal increase. But again, at the macro level, the studies would say really hasn't impacted corporates that much. At the micro level, if you're that company that has floating rate debt and didn't do much hedging, you're feeling this a lot right now, which is why we say, having that strategy before you need it. You want to have that insurance in place before you get into an accident or before the fire starts in your house. Because when the fire starts, it's already too late. You don't want to be calling around for insurance. So a big part of this is, what kind of company are you? Are you one that can withstand this scenario? And you might even have another cycle or two. We have a client that has predominantly issues 30-year debt. They have long-lived assets, investment grade. They're fine. It's probably the best way to put it. Next set of debt doesn't mature for like 15, 20 years. CFO probably, is feeling really good about the, pre-issuance hedges, forward-starting swaps that he executed when he was treasurer 3 years ago during COVID. So he's already locked out, debt that's coming due in several years at very low rates. How he feels is very different than the, high yield borrower that's having a tough time refinancing because the business is a little bit challenged and interest rates are higher. And that's a really challenging situation to navigate right now, because at some level you'll have to make a choice. At some point you have to make a choice of saying, do I go back to my existing lenders and try to get an extension? Do I do something more significant? How much am I really impacted from an interest coverage standpoint when rates are 2-3x higher than what they were when I financed this back in 2019, 2020?
Yeah. 15 to 20 years indeed sounds like a pretty safe horizon. You're pretty well off for the coming years. But so what about the investment grade companies that have debt maturing right now or 1 year ago or in 1 year, which have this safety and comfort of being investment grade, maybe even with a bit of excess cash, but need to walk through debt because that's how a lot of companies work. They're like, their debt is maturing now in a period of high yield interest rate, and they already extended their RCF, to take an example. What's the impact on them, and how should they approach it as a treasurer?
So an interesting thing, investment grade companies tend not to worry about capital availability. So that's good news. They get to optimize for cost of capital even more, and they're really fine tuning on cost of capital. So one trend that we've really seen that's been interesting, and is as volatility in rates has increased, and that doesn't just mean rates going up. We've seen the 10-year Treasury in the U.S., for example, crest over 5% and then go back down to 450 and then back up to 475. And this is literally, while people were probably having the discussions internally on whether we finance now or later, or what have you. It's literally in the span of days that we've seen these types of movements happening. Investment grade companies are actually paying more attention to tools that are available to them, like pre-issuance hedging, which is essentially allowing you to decouple pricing of your bond from, and the spread on your bond from the underlying interest rate at which you might issue. And so typical for an investment grade company, if you're going to do $1 billion issuance, is you do the issuance all in one day. You have the go, no go call in the morning. You decide, to issue or not, and you price $1 billion right then and there, which means you're at the whim of a few different things. One, you have specific windows on which you can issue, given earnings period, blackout period. Two, within those windows, you can delay by a day or two, of course, but you're a little bit at the whim of whatever rates are on those dates, right? If the 10-year Treasury, if it happened to be a day when the 10-year Treasury crested 5%, and the next day it went back down to 485, that's 15 basis points that you may have left on the table. And the hard thing is, it's not about trying to get the best rates in the market. It's about creating some level of predictability so that you can plan on a longer term basis for the business and for the capital structure. So the tool that we've seen a lot of investment grade companies leveraging, no pun intended, is these pre-issuance hedges, where they might dollar cost average into hedging what that 10-year rate might be. And rather than waiting for what it is on one day, and personal finance example, for any investments we do, generally dollar cost averaging leads to less volatility than picking one day. Now, maybe you pick that day and it was the best day in the market. Maybe you pick it's the worst day in the market. But that's not what corporate treasurers are paid for. As you both highlighted at the start of this conversation, they're focused on reducing volatility for their companies and ensuring liquidity. And that reduction in volatility comes from leveraging some of these tools that, when rates were 0%, wasn't something that people were paying as much attention to, as now we're seeing these big swings due to, changes that can happen, either geopolitical events or Powell speaking at a conference or, a presidential election. There are these big macroeconomic events that are happening that are driving it. You don't want to be the treasurer that's issuing the day that one of those events occurs, and you have no choice but to issue that day.
Indeed. And so what about the banks, Amol? Like, that's the corporate treasurer's perspective, the company's perspective. What about the banks? How should they approach this whole macroeconomic environment, and what have you seen happening in the consequences that they have to face and how they actually walk around those?
Yeah, so super interesting. I mean, as of now, banks they're not having great earnings years. And usually what that means is that they have to relook at their portfolio and figure out where they're investing and where they aren't investing. But banks are impacted by this higher cost of capital just as much as everyone else, right? They now, back to what we were talking about on the investment side, now banks are paying interest on deposits. That wasn't a thing as recently as just a few years ago. There was no interest really to pay. And so, banks are finding themselves, still, they have these deposits. They're not paying, full freight rates on, but they're higher than it was before. Their cost of capital has increased. They've had a hard time, depending on the bank and the markets in which they operate. And so for banks, actually, I would say what's interesting for them is that they have some competition, these alternative sources of capital that we've discussed. And so on one hand, they'd love to, lend out capital at higher and higher rates. but there are these competitors, for lack of a better term, that are out there. And an interesting trend we're seeing now is banks starting to actually partner with some of these shops and saying, you know what, we'll do some private lending either from our balance sheet, or we'll introduce others into this capital structure so that we as a bank are not taking on all the risk ourselves. There's some very significant innovation happening, I would say. And even in the next few months, we're going to see, and next few quarters, we're going to see meaningful changes to financing markets, even for investment grade companies. We're already starting to see that. Investment grade companies starting to partner with banks, alternative capital sources in different ways for project finance or infrastructure finance or specific investments that they might be making, looking at capital structures differently. And again, this is, you ask, what are the banks doing? The banks are figuring out how to make money. That's their job. They're figuring out how to do it while reducing their capital costs. And part of that is working with companies for creative solutions, whether you're investment grade or sub-investment grade. That's been the case.
Very interesting. Amol, give us a Treasury 101 take on how the current interest rates are linked to the derivatives market. And then also, how do interest rates impact the derivative market, and what's the derivative market doing right now?
Yeah, so I'd say we've seen, so the derivatives market has been really interesting for the past few years, especially on the rate side. One, rates have gone up a lot, as we've talked about. Two, we've actually seen one of the biggest changes that's ever happened in our lifetime occur with relatively little impact on both derivatives and financing markets, which is the move away from IBORs globally. LIBOR being the poster child in the U.S., but really all the IBORs going away has been a really significant change. And so derivative markets have had to withstand, one, I'd say increased scrutiny and volume as more companies, more users are leveraging derivatives in order to mitigate their interest rate risk, while changing the underlying index off of which everything is done in the world. It's the old, changing the tire while you're driving the car down the road. That is physically impossible, but that is exactly what's been asked of derivatives markets in the last several years. So we've weathered the IBOR transition. Higher rates has led to meaningful increase in usage of derivatives by end users, by corporates, by corporate treasury teams. And it's unfortunately a little bit reactionary. It would have been good to have done some of that hedging before rates went up by 400 basis points. But I think there's a lesson there for everyone. So we've seen a big increase there. In terms of derivatives themselves, I'd say the most commonly used derivatives we've seen by corporate treasury are, we've seen a lot more usage of interest rate swaps. Interest rate caps are still popular, but generally, depending on what you're trying to do, may have gotten materially more expensive. Whereas swaps in an inverted yield curve are allowing companies to actually lock in lower rates for longer periods of time. That's a very unusual situation. Most of the time, we have an upward sloping yield curve, so that means rates are higher in the future than they are rates are higher for longer term debt than they are for shorter term debt. Where we are today is rates are lower for shorter term or for longer term than shorter term, which is very different. And the other trend that we've seen, particularly for multinationals, is cross-currency swaps. So going from borrowing in one currency to another and finding some type of funding arbitrage that may not be readily available, as easily available in different funding markets. And so those tools have become increasingly popular for a variety of reasons. Namely, there are ways to reduce interest expense. That's been the big headline. Swap longer. We can actually go lower than what SOFR is today. And do a cross-currency swap. We can change our effective interest rate from, if you're borrowing in the U.S. at 5-6% something to Japan borrowing essentially at 2%. So those have been some of the trends that we've seen the last few months, certainly the last few quarters, I'd say, in the derivatives.
Could you explain us a bit, Amol, just to go back to Treasury 101 a bit? What's the cross-currency swap and why it is particularly relevant in that scenario? Like, why would companies tend to use that more in a high interest period.
Yeah. They can use it in any interest period, but cross-currency swap is taking a step back from this. It's an interest rate swap where a company is exchanging payments in one currency for payments in another. So let's take a simple example. Let's say you're a U.S.-based multinational. You're borrowing in U.S. dollars, and I'm going to make up these numbers. Please don't, if anyone's listening, don't go off and try to trade off of this. This is not live or real time, but conceptually, let's say you're borrowing in the U.S. at 7%, and you say, well, we happen to have a lot of positive earnings in Japan. What can we do with that? Well, one tool that they could do is say, hey, well, why don't we just go and borrow in Japan? Instead of borrowing in the U.S., why don't we repay our U.S. borrowings and go borrow in Japan? That could be great, but maybe they've never done a deal in Japan before. Maybe the quantum that the company wants to actually issue in Japan, given their earnings in Japan, is not large enough to warrant an issuance. Maybe you have to do a much larger issuance than the amount that you can really withstand. And so one tool that this company can use is a cross-currency swap. And in the cross-currency swap, essentially the company would go out and pay a Japanese yen interest rate, and I'm going to make up the number, let's say it's 2%, and receive 6% from their cross-currency swap counterpart. So now the company has a 6% bond in the US. Hopefully that was the number I used earlier.
I think it was, or 7, something like that. 6 or 7%.
Okay.
In those waters.
Let's go with 6 because I haven't got to acceptance yet either. Let's go with the old rates. So you're borrowing at 6% in the US. You enter into this cross-currency swap. You're receiving payments of 6% USD from your cross-currency swap counterparty. That cancels with your bond that you just issued or that you have outstanding. And now you're left with these 2% Japanese yen payments to your cross-currency swap. So essentially, it allows you to synthetically convert that US dollar offering into a yen offering. Now, again, that only makes sense if you already have Japanese yen exposure, i.e. you already have earnings that you can use or free cash flow that you can use to service that yen debt. If you create this yen exposure, but you don't have any yen currency, now you've actually traded interest rate risk for currency risk. And that's a whole different problem, which I'm happy to talk about too, because we spend a lot of time. But again, in this situation, the company has used a derivative rather than a financing vehicle to achieve its desired objective. And in this scenario, they've gone from 6% interest expense to 2% interest expense. It's a huge savings. Now, again, it's not a free lunch. You don't get to just do this. Like I said, you have to have that exposure to begin with. It's one way of essentially creating a natural hedge on that exposure that you have. It may be better, it may be worse than doing a natural yen issuance. So companies really have to evaluate all these different tools, but it's much faster to execute than doing a yen issuance. So much faster than doing yen issuance. Even for a high yield or investment grade company, cross-currency swaps tend to be a quicker path that can be executed within days rather than within weeks or months.
That is super interesting. And so they're able to do that because they have a strong activity in the US, for instance, but also some free cash flows in Japan. In Japan, just to stick to the example, right? Though this is not financial advice. They have revenues in Japan that they're able to leverage into executing a cross-currency swap from their debt in USD to an interest rate repayment in JPY. That's where the magic happens.
That's exactly right. It's essentially as if you had borrowed yen. It's essentially as if you just borrowed yen, and had you borrowed in the yen markets, your interest rate would be lower because Japanese interest rates are lower. Yeah. And so again, it's a synthetic way of achieving the desired outcome. And that's really all derivatives are. For any of your listeners that aren't as familiar with them, it's an overlay on top of what you have, and you can create these synthetic exposures to whatever you like. Synthetic yen exposure, synthetic fixed rate exposure, turn a term loan B from a SOFR plus into a fixed rate, essentially turning fixed rate debt into floating rate debts. It's an overlay on top of your existing capital structure.
Absolutely awesome. And so are there any other innovative approaches or strategies that companies can take or should consider in light of these shifts? And when in a period of high interest rates, this cross-currency swap is an excellent one. What else do you recommend the people you talk to and your clients, Amol? What else is out there that corporate treasurers can leverage to navigate those choppy waters, let's say?
Yeah, I think I'm going to share a counterintuitive idea with folks, and that's actually to borrow floating rates. That is, see, I see your head shaking. But let me tell you why. This actually goes back to your the investments conversation we were having earlier. You're an investment grade company. You have cash on hand. You have short-term securities. You're earning interest on those. Most investment grade companies have a very heavily fixed rate debt capital structure. And when rates were really low, to the extent that they had policies, which most of them do, around their fixed floating mix, they skewed very heavily towards the fixed rate side. What's interesting is that, think about the rate environment we're in now. And if rates go higher, from an asset liability standpoint, your assets, you'll earn more on your assets. This is overly simplified, but you'll earn more on your assets, in that world. And you might, your cost of debt will still be fixed. But if rates go lower, you're going to earn less on your assets and your cost of debt is still fixed. So now you've actually introduced interest rate risk to the company that you may have thought was not initially there. So one argument is to actually go floating, particularly for investment grade companies, to have more floating rate exposure because it will offset some of the assets. To take it one step further, though, it's not enough just to think about assets. It's important to think about your business volatility as well. And so if you have a business that will do exceptionally well or exceptionally poorly in different, call it macroeconomic cycles, it's worth thinking through the impact that has. And that might indicate that you actually want more floating rate debt or less floating rate debt. If you have a cyclical business that will actually have less revenue in times of in economically challenged times or fewer earnings in economically challenged times, you might actually want to have some debt that allows you to take advantage of that, i.e., floating rate debt, assuming that economically challenged times are equivalent to central banks reducing interest rates. So I recognize it's very counterintuitive advice given the era of high rates, but it's actually it's a more complicated concept than just saying, let me pick high rates or low rates, because if you have the ability to mitigate that risk through your business, or that risk can be accentuated through your capital structure and through your assets and how you generate cash as a business, it's all worth taking into consideration before making some blanket statement on be all fixed or be all floating.
Amol, do you see any impact of this on the way treasury departments are also managing their FX? I mean, you can't really talk interest rates without talking interest rates differentials, especially nowadays. We see across lots of different countries, different central bank policies really affecting the differences in these bond markets and interest rates in different countries. That tends to drive FX up and down one way or the other as well. Are those two conversations not intrinsically linked? And if so, how is that affected nowadays?
Yeah, they definitely are linked. I think they sometimes tend to get separated from one another, but it's hard to really totally separate them. Maybe a few things we've seen, and then let's take a step back the last few years. We've seen historical dollar strength. That's good or bad for companies depending on your perspective and currency footprint. We saw that historic strength followed by a rapid weakening of the dollar. And everyone thought, that was just a little short-term blip. We don't need to think about that anymore. And of course, that was followed by a return to strength of the dollar. I think more than even interest rates, what we're living through is a time period where many corporate treasury professionals and corporate finance professionals just haven't seen. We haven't seen a scenario where we have globally high interest rates while arguably the largest or second largest economy in the world is actually slowing down. That is not a scenario that we have seen in quite a long time, and we don't know exactly what that will mean for everybody. So the consequence of this on FX is, and I hate to be a little bit of a broken record, it's have a game plan, have a policy. that survives any market environment. Is what we've seen. A lot of companies are looking back at the policies and their programs and saying, hey, this isn't quite doing what I thought it was going to be doing. Or we had a company come to us not that long ago and say, we're hedging everything, literally hedging everything. We're spending tens of millions of dollars on forward points on our balance sheet program. And I'm not actually reducing that much risk. Like if only I could just stop hedging these three currencies, what we told them was, you could save half your expenses and you'd still be reducing something like 85% of the risk. Is that trade-off worth it or not? Some CFOs will say, absolutely not. I never want to answer an FX call on an earnings call or FX question on an earnings call. So hedge everything. I don't care what it costs. Most CFOs don't say that. Most CFOs say, if you can get 85% of the benefit for only 50% of the cost, that's a good trade. Let's do that. And so really, forward points are changing to your point. But more broadly, there's more volatility. And it's a very different macro environment than what we've seen, which means taking another look at the program. And the interesting reality is only about half of multinationals hedge their FX. That's surprisingly low, if you ask me. And that doesn't mean you need this big, robust program that a Fortune 100 would do, Fortune 50 would do. But there are tools and capabilities that are out there that can allow even, I'd call it billion-dollar turnover companies to be able to run programs effectively and efficiently, like companies that are 100 times their size.
And do you see that also seep into these? Because I think one of the interesting things that's come out of this conversation, Amol, is the insight into these innovative products that are coming out that are helping us navigate these kind of environments. So do you see the same thing in FX? I mean, you talked about the currency swaps earlier. Anything else that you saw that really impacts this FX hedging space?
So I'm going to say something that's going to probably be unpopular with some of the audience. But are you okay if I can get a little controversial here?
We're prepared. We're prepared.
Oh, okay. So I think there's a lot of innovative products being pitched in FX today, most of which are not at all fit for purpose. And so I tried to tone it down a little bit.
Mellow, yeah.
And probably most companies should be using forwards, not options. This is not a blanket statement, but if you're being sold double knock-in, knock-out products or any type of exotic FX trade, which is allowing you to maybe get a better rate or get more flexibility, my suspicion is that it's not fit for purpose, and it will go away when you need it the most. And so, again, it's a bit of a blanket statement, but it's important to note that I think financing markets, like all markets, when you hit a challenge or stumble, derivatives markets, financing markets, there are creative solutions around all of the problems that exist. Some of those are good creative solutions, and some of them are bad creative solutions. Knowing the difference is what separates, the companies that are going to, be able to withstand these types of challenges, and the treasury professionals that are going to be able to make it through multiple cycles, versus those that are going to be short-term focused and just make it through, the next month or quarter. And as unpopular as it is to go to the board or the CFO, I think one of the most important conversations that treasurers can have today is saying, I know this feels hard. Yes, the cost is higher. Here's why this makes sense on a long-term basis, because it's the treasurer's job to think liquidity and long-term for the company. And if he or she is overridden by the board or the CFO or the CEO, that's a different story. But it takes courage to have the difficult conversations.
Super interesting. So keep it simple is the large message, especially when it comes to FX. Don't get drawn into the fairy tales that some of these products are bringing.
That's exactly right. It's there's no such thing as a free lunch, as the old phrase that or what do they say? If you've ever played poker and you don't know who the sucker is, then yes, exactly. So again, I think it's not to denigrate all products and all situations and those who are pitching these, there's absolutely value in them. There are absolutely scenarios, and we've seen it where companies have very complex contracts with their customers. They might actually have embedded options with their customers that would be best by offsetting them, but with different structures of options with counterparties on the FX side. Generally, I would say stick to the simple on FX, and we're seeing that today. That companies are the biggest questions that CFOs are asking treasurers and boards are asking treasurers are: am I protected? What happens if XYZ occurs? And before it was what happens if the euro breaks up. Now it's what happens if the dollar goes back and we break parity on the euro again. Are we okay? What does this mean for us? And the most sophisticated treasurers actually tend to keep it the most simple. It has been my experience.
And if you'd allow me, Amol, to play a bit with the topic, what do you think about the AI advancements and innovations when it comes to FX and interest rate risk management? Are they to be put in the same bucket for now because maybe they are not advanced enough? Have you seen some solutions that actually bring huge or at least substantial benefits? What's your overall opinion about artificial intelligence, especially in those tools that help corporates navigate foreign currency management?
Well, given how fast AI is improving and changing, I think I'd probably be a little bit of a fool to say that it's not going to impact anything. We have seen some, and we have some tools that are leveraging these different capabilities. And one question that companies often spend a lot of time on is, where is all of my noise coming from in my FX? I have FX exposures. I have FX hedges. Why aren't they perfectly matching one another? The way to answer that is analyzing lots and lots and lots of data. It's not just how much euro exposure do I have and how much euro hedges do I have. It's when did that euro exposure come on? At what rate did it come on? Was the euro exposure actually euro exposure, or was it dollar exposure that somebody in Belgium booked as euro exposure even though it was really dollar exposure? It's getting into all these types of weeds, which requires it requires analysis of the data as well as insight into an organization. And my suspicion is that there are tools that will be developed over time that will take at least one piece of that equation and make it a button click, as opposed to diving into an Excel spreadsheet, thousands of rows, lots of different lines, understanding what each of them means. Whether AI will be able to understand whether the person who inputs invoices in Belgium actually meant to put it in euros or dollars, I don't know. I don't want to guess on that, but it's been surprisingly helpful and helped my parents plan a trip to Scotland a year or so ago. So you can probably get a lot. You can probably get a lot more out of AI than we think. But I think in the FX and I'd say corporate finance world, there's some room to go before we get to that realized state. I wouldn't ignore it, but I wouldn't say we're there yet.
Amazing. Amol, thank you so much for that. We'd like to talk a bit about Chatham Financials. Could you walk us through what the mission statement of Chatham Financial is, please?
Yeah, so Chatham, Guillaume, exists to partner with our clients to enable them to have the best possible capital markets plans, whether that comes a debt capital markets strategy to derivatives and financial risk management. We aim to be the first call for our clients when they're thinking about anything related to capital markets activity. We have been in business for over 30 years. We work with over 3,000 companies globally. We have offices headquartered in the U.S., but offices and multiple offices in Europe, multiple offices in the Asia Pacific and Australia region, multiple offices here in the U.S. as well, and working across all industries. So whether you're a tech company, a commercial real estate firm, private equity sponsor, financial institution, insurance company, we have insight across all of those different industries and provide capital markets solutions, again, whether they're advisory in nature or technology based, that are focused ultimately on that goal that I mentioned, which is enabling our clients to have the best possible capital markets plan.
And so, where do you operate? Is it mostly the US, or are you elsewhere as well?
We're a global company, so we have clients. While we were started in the US, we have a large footprint in Europe. Our headquarters is in London, and we work with hundreds of companies in the UK and on the continent. Operate in the Australia, Asia Pacific region as well, because our clients tend to be global. We tend to work with large institutions, whether they're large alternative asset managers that are investing in commercial real estate and private equity and corporate private equity or infrastructure, or they are insurance companies that are operating one part of the globe or another, or multinational corporates that have operations all over the place. We found that over the years, having that ability to serve our clients in their local geographies, as well as having the scale that comes with a global footprint, are really ultimately beneficial to our clients, because we can give some insights that you can't get if you're just in the U.S. or in London or in Singapore. The ability to combine all of that knowledge together allows us to give even better insight to our clients.
Super clear. And so I actually heard, Amol, while we were researching for this, you guys recently made quite a big acquisition. Can you tell us about it?
Yes, we acquired a company called EA Markets. We're very excited to bring them and their team and their founder, Ruben Daniels, to Chatham. EA Markets is an investment bank, really agnostic to industry, but focused on enabling their clients to have the best overall debt and structured equity capital markets plans. So working with large companies all the way down to smaller companies, very focused on being on the side of the table as their clients. And so they have the same ethos as we do at Chatham, and we're excited to be able to bring this type of debt capital markets, structured equity capital markets capability into our clients on a broader basis. We've worked with our clients on derivative transactions for years, but as we talked about earlier, a derivative is just an overlay. You don't do a derivative without having, for example, some type of debts that you're trying to manage. And very often our clients would come to us and say, hey, what you do for us on the derivative side, helping us structure them, get the best price for them, think through all the conflicts, provide all the support related to it. Can you do that on the debt side? And our answer was, we have some expertise there, but not all the expertise. And now we're really excited to be able to have this broader offering to our clients.
Super interesting. And how does the acquisition, Amol, fit with your broader landscape that we just talked about the interest rates going up, the FX and whatnot, and the evolving needs of corporate treasurers?
Yeah, the acquisition really allows us to offer a broader set of creative solutions to our clients when they're facing these exact challenges and problems of, I have higher interest rates, I don't have as much capital available, what can I do? What's the best way to fill this gap between what I want to do and what's available to me? Bringing in a team like the EA team and a professional like Ruben allows us to really be able to better answer those questions to our clients. We only exist because our clients are asking these types of questions and trying to solve these types of problems. And we've always felt that it's important to be true experts and not just walk into a room and say, oh, you could do X, Y, and Z without knowing how to do X, Y, and Z. And so it's perfectly aligned with our vision of being that capital markets partner and now just bringing in more expertise to be able to support our clients as they're going through these types of decisions.
Well, thank you so much for that masterclass. I think it was, I think it's a topic that everyone has heard enough times that, okay, interest rates are high. I liked your more holistic perspective that, look, yeah, interest rate are high. That affects some companies that maybe did have their debt restructuring coming now, if you're unlucky to do so, or they're on the floating side of things with their debt. The ones, a lot of clients, it's interesting also, yeah, you don't really think about the ones that aren't affected by the high interest rates, right? Which is the ones that had their debt, they're laughing now. They're like, thank God we just restructured 2 years ago, 3 years ago, 5 years ago for 30 years, for example. So that definitely puts them in a much better position. Or if indeed you're cash rich. And then the interesting thing on these new products that seem to be helping out with a lot of these things. And then, of course, that fact that perhaps you should have a floating interest rate on a lot of the debt that you're covering right now, which tells me that you do believe it's going to come down again, the interest rates, or there's a good chance of it, and you're with the market on that. Is that the right way to put it?
I think it's hard to fight the market, but over a long enough time period, I find it highly unlikely that we're going to stay at 5% forever for the next 50 years. I mean, there's going to be ups, there's going to be downs. And it's back to what we talked about earlier, Sam. It's, what kind of plan do you have as an organization that will survive, any of these types of challenges that might come up against it? It might not be the perfect plan in all situations and in all environments, but what's available that you can then fine tune as you have more insight into what's happening on the business, what's happening in the environment. And I think that's really, even those companies that you mentioned that are not impacted, what they're spending their time on is thinking about what's next or what's next. They're not just, I don't think anyone in corporate treasury just gets to sit there and twiddle their thumbs and say, look, everything's great. And so I think that's an important insight for everyone to have, that even if you're not impacted, you still are impacted. For those that are really dealing with these decisions right now, it's as good a time as any to think deeply about what the future is going to look like for your organization as well as for the markets.
Yeah, I like that perspective as well. Don't have this fear of it's terrible right now. Make the best plan that you can with the current situation. And I think that's spoken like a good corporate treasurer, I think, is indeed to have that strategy. Amol, thank you so much. And is there anything about any of the topics that we didn't cover that you want to add on?
No, I don't think so. I think we covered a lot of different topics, and I'm not even sure what time it is. But okay, time has flown by.
Yeah, indeed, we filled up a whole hour. Don't worry, we have a good episode out of it as well. And if people want to find out more about you or Chatham Financial, where can they go to do that?
Yeah, please feel free to come to our website, www.chathamfinancial.com. We have a lot of great insights on there around markets, around what's happening with clients, and you can reach out to me or any one of my fellow team members to talk about different ways that Chatham can help you and support your organization.
And all those links will be in the show notes below. Amol, thank you so much.
Thank you.